Sure. All right. So this is session 4 of Wealth Mastery for Women, and we're going to be talking about strategic diversification for enhanced returns and reduced risk. The purpose of this roundtable has always been and will always be about empowering ourselves with information that is not necessarily the traditional information that is out there, and it's really meant for everyone to come in with an open mind, open questions. This is a non-judgmental space, and whatever we cover, especially if it's something that is very different from what you know, or you ever feel like I have no idea what's going on, it's really important. Really, really important that if you feel anything that I feel bad about myself or shame, or I should have known this, please leave that out the door. It's no good. This is a really safe, open space. So this is really meant to open our minds and create access and communication, because that's how we get to opportunities to grow and build our wealth. So this is a safe space to ask all your questions, especially when you feel like I really don't know that, or I should have known something. It's never the case, ever the case. So we're going to talk about diversification, and let's get into it, Jennifer.
Okay, and we should probably introduce ourselves just a little bit. Hi, I am Jennifer Burnham Grubbs. I'm owner and founder of Quantum Insurance Services. We're a commissions agnostic insurance consulting firm based out of Los Angeles. We have clients all throughout the US, and our mission is to help people demystify insurance products, get the best value out of their risk management strategies, and then also to be a big part in helping people maximize the value of their money and wealth, because we truly believe money is a magnifier. So if you have more of it, then you can magnify the good that you can do. So kind of efficiency is the key to success.
Right. And I'm Adapia Dorico, and I work in real estate syndication. So for the most part, I'm working with accredited and high net worth, ultra high net worth individuals to add private commercial real estate syndication to their portfolios. I have a background in finance, started working in a bank when I was 18. I've had a varied career within the space, and I'm also the co-founder of Women of Wealth with Jennifer. And really this mission, this is my life's mission, is to create more access for women to build their wealth sustainably and joyfully and easefully. So we're really on a mission now to share this information, to have the conversations that help us all grow our wealth, so that we can put that wealth back out into the world and create the world that we want to see.
Yes. And Adapia, I'm glad you said something at the beginning of this about no shame around questions. Adapia and I both have come to where we are today in terms of this empowered approach through finding out that nobody's smarter, actually, really. At the end of the day, like, there's this part in the back of your mind probably that always thinks there's some typically older white male who knows better, is a master of certain products, and you're not, or I'm, and I discovered early on that that's just a myth, that we disempower ourselves, especially as women, by assuming we're not able, or that someone knows better than us. And then when we ask questions, we're just as good as anybody else at figuring this stuff out. And so I know Adapia has gone on journeys as well with discovery, and I know that's so important to the crux of what we're doing here. So truly, as you learn anything here today, if it feels over your head, just know that's okay. That's actually normal, and no one can know everything. And then the key is just learning how to give yourself permission to find out and ask things and grow and take little risks. And then all of a sudden you're just as good as everybody else at this. And so that's kind of really important as we get into this, because some of this might sound fancy, but at the end of the day, it's really not. And so we can kind of jump right into that, I guess, Adapia, if you want, and talk about.
Yeah, absolutely. So let's just look at how diversification is traditionally defined as it relates to investing. And this is a definition from Investopedia. So diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. The rationale behind this technique is that a portfolio constructed of different kinds of assets will, on average, yield higher long-term returns and lower the risk of any individual holding or security. So a diversified portfolio that contains a mix of distinct asset types and investment vehicles limits exposure to any single asset or risk. So in the short form is that it's a risk mitigation strategy and that it'll average your returns over time. This is the traditional definition as it's applied to portfolio construction.
Sorry about that. I was trying to get it into presenter view right while you were reading that. So sorry about that. I just kind of want to add that the simple way to think about diversification is that we've all heard it, don't put all your eggs in one basket, right? And the idea is because if anything happens to that one basket, you're screwed. And in itself, it's a sound concept, right? Because we all want to be very stable, especially women really value security and stability. So in and of itself, diversification is a good thing and is a smart idea. The issue is what's happened to the concept of diversification in practice, in actual practice, especially over the course of the last 20, 30 years, and how the general layperson is taught to think that they're diversifying. And that's one of the main things that people need to become more aware about. So if it's okay, Adipia, I guess I'll jump in and do this slide, or did you want to?
Oh, no, it's your slides.
Okay. So where we believe the definition of diversification has really gone off the rails is that most people engage with investments only insofar as they have some kind of money in the stock market. It's maybe their IRA, their 401k, or whatever. And they think that they're diversified because they have some combination of stocks and bonds. Like in the picture before, there's a basket and in it is a bunch of eggs, and some of them are white, some of them are speckled, and some are brown, right? And so they're thinking, well, yeah, I have some stocks and I have some bonds and they're in different companies and different sectors. So I'm diversified. But what that really is like having one planter that you just like threw some seeds into and just hoped for the best. And then you're like, well, whatever's growing there is growing, and it's not all this, it's not all celery. And then you have a garden that looks kind of like this instead of something like this, which is what you really want your financial diversified world of investments and investment portfolio to be, which is truthfully something that's been tended and thoughtfully put together and cared for so that it's yielding truthfully for you in a very good way. And so diversification has come to be, for most people, well, I'm going to kind of robo-assign to somebody who's some expert, something, some combination of stocks and bonds. It's in the market, so I'm diversified, and that's couldn't be more far from the truth of what it really is to diversify. So here, Adipia, you can take this.
Yeah. So in, so I guess in practice, what we're seeing, a portfolio diversification typically looks like stocks, bonds, cash and cash equivalents, and it's usually packaged as mutual funds, index funds, and more recently ETFs. And, ETFs are expected to hold about, about 30, I think it's like 13 or $30 trillion in total capitalization in the next few years. So basically, like, we've been taught to put our money in ETFs because that's how we diversify, that's how we reduce risk. But more importantly, it's easy and it's convenient, which is true. And so, but there's some downsides to that we're going to look at here in a moment. Because most of us just don't have time. I know some great people, really wonderful. They like to pick stocks. They understand the bond market. They want to do this and they've built their portfolio, but most people don't want to do that. And so this is why the industry went down the path of ETFs. And your typical guidance looks like, what's your strategy? What's your style, age, duration? When do you want to retire? And it's gone all the way through from stockbroker to mutual funds to, to robo advisors, your financial advisors, all the way down to robo advisors, where you click a few buttons, answer a few questions on the UX form online, and then all of a sudden you have your portfolio. But that's not exactly not putting all your eggs in one basket, because you're still only putting your eggs in the Wall Street basket.
And this is a huge pet peeve of mine. I learned this and I was so shocked. Like by the time I was participating in my second 401k, somewhere along the line, it was a whole different company. I think originally I was maybe Vanguard, then it was Transamerica or whatever. And as I was onboarding, I got the same 6 questions. It was like, how old are you? What year are you hoping to retire? Are you medium, risk averse, medium, or are you okay with risk? And it was like this whole fancy thing, but really all they were doing was asking me the same questions that the last company had asked me. And it was so cookie cutter. And then it was like, well, then you should sign up for this fund, which is I'm planning to retire in 2035, or I'm planning to retire in 2040, or I'm planning to retire in 2030. And it was just, I started to see that a lot of this was just sort of smoke and mirrors, getting very boxed into very basic questions and not at all any kind of complexity. And again, all about just getting into the stock market, which is why it's possible for robots and programs to do this, as well as 95% of financial advisors can't actually outplay a mutual fund. Just because at the end of the day, the way the stock market is built is taking your money for a long period of time, and we'll talk about this, and then having plenty of room for error and hoping or expecting that it will ultimately end up on the right side of the equation and come out in the wash and you'll be ahead. So it's not a very precise process.
Yeah, exactly. Yeah. I mean, there's so much research. It's pretty much uncontested at this point that 95% of any manager of money does not beat the market over time, which is why broad market diversification ETFs are what is mostly sold, right? Put your money in the S&P 500 index and dollar cost average in. This is one of the strategies. It's not a wrong strategy by any means, but here's the thing: are you actually diversified? And specifically in the US, I'm not as familiar with foreign markets at the moment, but I would imagine it's the same in the developed countries. The US stock market's not trading based on fundamentals. For those who follow, PE ratios are, especially before this most recent volatility and drawdown, they were way out of whack. They were really high. Most of the stock market has been pushed up in the past few years due to monetary policy. There's so much money that's been printed, and that money is looking for returns, and it's gone mostly into the stock market. So there's just not a lot of fundamentals. And so what does this mean? This means that the indexes that we're investing into with ETFs are not actually offering the diversification we think they should be, because they're market cap weighted. And this is a quote from a Wall Street Journal article in December. So 5 of the biggest stocks in the S&P account for more than half of the gains that the S&P had since April. So when you have 5 companies that are responsible for a third or more of gains, what happens if those 5 companies get hit hard? What happened to, if anybody has a FANG index, Facebook, Alphabet, Amazon, Netflix, Google, what happened to your index that's supposedly diversified when Facebook took a big hit, when Netflix took a big hit recently? It went down because it's not really diversified when it's by market cap.
Just to kind of make that a little in basic language, because Aditya is so smart, and I know that she can use words that might intimidate some people because she knows this stuff in and out. Think of it like you think you're diversifying along this broad base of all these different stocks and bonds, but in the reality, what the stock market's been doing, it's been propped up, and 5 big names are carrying all the ups and downs for the most part. So in reality, even though you think you're diversified in this mutual fund, you're basically in 5 stocks, and your whole future is hanging on 5 stocks. It's not diversification at all. The other thing, and Adipia, I think you can do a really good job speaking to this slide, is that the way we're taught to think about diversification is just hand the money over and let it ride and let it ride. And that's a very passive approach to diversifying. Even just the fact that it's all in one silo, which is the stock market. And in that, though you think you're in a whole bunch of stocks, you're actually being carried by maybe the 5 big names that happen to be carrying the big stock market, big cap funds. Also, it's a super passive thing. It's just like put all the money there, let it ride, and don't look at it again for maybe 30 years. And if you look at what happened in the last crash, which I was there for it, okay, you saw trillions of dollars being lost. Many people lost up to 30% of their entire life savings. Everybody remembers Enron. 20 or 30% of your life savings is a significant amount. And what's terrible about that is you trusted for 30 years and then you were just hoping it all worked out. You didn't do anything really actively to manage your money in any sense. You were like a good girl or a good boy and you handed your money over and you expected it would be there for you, but you really never had any guarantees along the way. And you really weren't a participant much in watching it the whole time. And unfortunately, it can go very badly. And we've already seen that once before. And we do know that we're kind of going to come back into another crash. We've been on a great ride for a while. So things were looking so great. And everybody has this amnesia that this is the stock market. There are ups and downs, but we're getting ready to have a downtime. And the other big problem is anytime there's a significant downturn, it takes so long to recover from it. It's kind of like if you have, if any of you have kids, and maybe your kid does pretty well, does like, B's and some high C's and some, low A's on their math, and then they flunk one test, right? Their whole grade average can come way down just because getting a 0 or a negative brings the average down so much. Oh,
that's okay.
Here, what happened here? It's a little, bear with me.
Okay, we can go to that slide.
There we go. Okay.
Yeah. So basically, one of the things that really became clear to me when I was thinking through this is that this passive approach, this Wall Street passive approach, is put on a very specific timeline. It happens. Where does it happen? It happens in retirement accounts. And it's geared towards the future. So when we're doing this work of this passive investing, our 401ks or RSPs, whatever it is, we're thinking about the future. And we're banking and hoping and praying that in the future that portfolio will be there and that it will grow over time. But here's my issue with it is that time horizon, yes, it's in the future, and there's so many factors, there's so many things that can happen between now and then. And we're actually giving away power by not taking a more active approach to our current investment strategy for what we need today. And we actually are putting all our eggs in one basket, the 401k, the RRSP basket, and setting it and forgetting it. And so I know, Jennifer, you might want to speak to allowing those who profit from our funds, but essentially the big takeaway here is, what are we doing this for? We're doing this for later, which helps us kind of think, oh, I don't need to think about it, right? I'll just put it there and it'll be fine because over time it's going to grow. So we're going to, on the next couple slides, we're going to get into a different way to think about diversification, because we can't only be thinking about the future and hoping that the market is going to carry us into retirement.
Yeah. I mean, I think to your point, 30 years is a long time to just give all of your power away, especially because while you're in your peak earning years is where you have the most opportunity to make more active choices and change your returns on how you've chosen to allocate into potential growth strategies. And one of the things I really like to point out, because I just feel it's not discussed at all, is that when your money is being put into a 401k or an IRA, there are people profiting. There are many, many fees built into those everywhere you go. Typically, your fees, if you ever actually looked under the hood, are between 2% and 3%. because you've got an advisor attached who's taking their 1 to 1.5 or sometimes less if you have a huge amount of money. And then within each fund, in your mutual fund or wherever, there are also fees being taken out all the time. And those fees are taken out whether they've actually grown your money or lost your money. It doesn't matter. They get paid regardless. They get paid regardless of performance, a significant amount, 2 to 3% of your money for 30 years. And at the end of the day, most of the time, they're virtually doing actually nothing at all. They're just funneling your money into these funds that are being, it's not even really managed, but that I could go on about that. But it's really important because people really forget that they're paying these people a lot of money, and yet their money's not even being actively managed by the people that they're paying to do it.
And so here's the thing. What about today? What about the present? We have some current risks that we really need to think about, including, and especially these days, inflation. It's a stated 7.5%, but I'm pretty sure we can all agree that it's a lot higher. Everything costs a heck of a lot more than 7.5% more. We have some needs. We have income. We need different kinds of income now. And then there's time sensitive opportunities, right? This is not just about retirement. This is about right now. We might have health expenses. We want to think about the time value of money. And so what we're looking for, and I'm curious if you want to put in the chat, like, what are some of the risks you see in your life today financially? And what are some of your needs? Because that 30-year time horizon of, within that span of 30 years, we're just going to average out all the risks and all the returns. That doesn't help you now, because what we want now is we want more time. And what we need is a diversification of income, but without working more hours. So there's a different form of diversification. And Jennifer, I don't know if that's on the next slide, but we don't want to, we don't want to aim for average, right? Like the wealthiest investors, the most sophisticated investors, they don't aim for average returns because that also waters down your returns, the average. We want to be actively diversifying. Doesn't have to be another full-time job. There's some strategic investments that allow you to actively diversify. And you want to put your money to work for you like right now. Like today, not 30 years from now, not averaging out all the ups and downs, but having that money actively diversified, not actively managed, but actively diversified so that it's giving you more sources of income.
Yeah. And one of the other things I want to mention, going back to this slide, so it's kind of like tilted towards retirement in 30 years, but some of us are going to need less money when we retire than we need now. When you are raising children, trying to pay for them to be in school or all college, all the other things, you need your money more now. Once you're not trying to carry some dependence, you don't even need as much. So trying to find ways to leverage now when you're in your peak earning years and in your peak health and capitalizing on that to transfer that into actual money in real time for while you need it the most. Of course, you still want to do retirement planning and you're still going to be in the stock market and your 401k, but it's just about learning to truly diversify and think outside the box. And what we really want to do is we can't cover everything in one class, but we want to teach you how to start learning how to just look outside of that one worldview that everybody is kind of taught to have. Because as soon as you start to do that, you can so easily find so many different ways to diversify for real.
Yeah. And I like income, cash flow is the underappreciated key to wealth. And it's what wealthy investors really, really, really understand. They're not just diversifying stocks and bonds, they're diversifying how they make their money, where that money comes from, but without having to work more hours because our bodies can only work so much. We are already way overstretched. We're already doing so much. We don't need another job. We need that money to be making money for us. So the key to real wealth today And so short term, medium term, long term is income for two reasons. One, that income from cash flow can be reinvested, so compound returns, and not just banking on the value of, let's say, that stock, bond, or mutual fund going higher over time. But if you have income coming in regularly, you can invest it regularly and you make more money over time. And the second one is that by having cash flowing investments, and they give you these other sources of income, you can create a whole new life for yourself. You can work fewer hours if you want to. You can use that money. I don't know, maybe you're maybe a project at home, building a home, you have other cash flow coming, just changes your life. And you're also not worried so much. This is really important because I'm always thinking about what are my downside risks? Like how can something like take me out? And I want to have all my bases covered. And my income from my salary or my job or my work, that doesn't feel safe to me ever. Even though I'm relatively speaking, I'm safe, but I don't feel safe unless I know that I have other sources of income that I can rely on just in case, because you never know. And that's just me. And I'm happy to always share and be really open because like that kind of stuff freaks me out. And so having cash flow from other investments where I don't have to manage those investments in the actual sense of the word. I'm not the one managing the execution of them, but that allows me to have other sources of income that cover increasing expenses. I might use them for my home renovation. I might use them for vacation. And most of the time I'm just reinvesting them so that I'm compounding returns even more. And so this is the real key here with the diversification that we were talking about is like, it's not just the traditional diversification, but it's income diversification.
And looking at what you're getting back from it instead of just giving your money to it and hoping it will then grow. It's even Warren Buffett, one of his key principles of investing is look for dividend returning assets. So he's smart about it. He knows like, it's not just, I'm going to give you my money for 30 years and hope that ultimately it grew. It's also, what can you get me today or in the near term, in 2 years, 3 years, 5 years, 10 years, also because he's very conscious about the time value of his money. And also to your point, Adipia, one of the things I love that you say is learning how to make it position ourselves so that we don't just work for our money. Our money also works for us. Because again, there is only so many hours a human can give. And we all probably are maxed out, close to max at that. And learning how to create passive income through income producing investments. Oops.
The most well-known, and it's interesting when you bring up Warren Buffett, because yes, he invests in stocks technically, but he's investing as a private, basically as private equity. I mean, he's buying such large shares of the companies that he's owning them. So different. Everybody, I mean, he's the most amazing investor, but very I don't know anybody that's like him, right? And so sometimes these quotes, and when they use these people, it's like, that's fine, but he's not buying ETFs. He's buying private equity. He's owning, and a lot of other people, they own real estate. Your best income producing investments are private equity, so other businesses, it's real estate, oil and gas, and guaranteed cash value life insurance, which Jennifer knows so much about. So when you can diversify your investments to create more income today. And these are the most well-known and the most solid of those income producing investments.
And there are others. There's so much else. There's NFTs. There's crypto. And those, of course, they're complex and they're very high risk and dynamic, but the whole point is realize that I have clients like this, people who make $20 million a year in the market. They are not investing the way like we're like peons in comparison. They don't do it the way we do. They don't just throw it like that and hope it grows into something. They're very strategic in exactly what they're doing. They're using it for them. They're not just giving it away like that. And then they also diversify outside of the market. So again, Warren Buffett is one of the biggest investors in permanent life insurance products also, because he's very curious. He's very educated. He does his research. He's also in real estate. He's not just in the stock market, even though that's what he's famous for. He doesn't put all of his eggs in one basket, and neither should any of us. I think one of the keys that, especially now, because with technology, things are possible in a way they never were before. We're in such an exciting time just in history, is each of us is now able to treat ourselves like a family office. And by family office, what I mean is whatever your amount of money, and it can be plus or minus 6 zeros, right? Like everything's got proportion to it. But if you even have a very small budget to work with, you can treat your own budget of what you have to invest and do as if you are Warren Buffett. You can take yourself as seriously as that, because whatever you do, the moment you start tending and growing, you can start to grow it. And then you can have your own garden. Most of us don't need to have as much money as Warren Buffett. We're not even interested in that. We're just happy to have enough to like live farm to table and have plenty of tomatoes and cucumbers and peppers in season, and then butternut squash in the winter, and we'll be perfectly happy. And every one of us is capable of diversifying for real and growing our money. So we can go to the next slide. But we just have to start thinking outside of just this autopilot kind of rote thing that we've all been so trained to do. And this gets to the power of non-correlated assets. So a non-correlated asset, what that really is, because it sounds very fancy, all that means is that it's not in the stock market. It's literally anything other than the stock market is a non-correlated asset. And it just shows how much the stock market owns kind of like the thinking around finance, that they consider themselves the base and everything else is non-correlated, when for centuries, real estate has been a sector. I know my grandmother was a single mom and a school teacher, and she was shrewd about real estate. And so she would scrounge her money together, get a little rental property, and manage to raise 3 children as a school teacher just because she knew the value of real estate back then. So it's not like real estate is new. It's not like life insurance is new. It's not like most of these non-correlated assets are new. It's just that for whatever reason, the stock market's taken over and a little bit too much in our opinions. So when you have something uncorrelated, what's good about it is the stock market, as we know, goes up and down. Well, if you're completely tied to the stock market and everyone's tied to this one very erratic heartbeat that goes up and down, then everyone's been exposed to the erratic heartbeat all at the same time. But if you have some investments that are growing at different paces and in different sectors, then you're not as controlled by the ups and downs of frankly, the riskiest one of all, which is the stock market, because the stock market literally is completely no guarantees. It's just, it is what it is. Buying a bond does not protect you from ups and downs in the stock market. Not really. So an uncorrelated asset is just anything that doesn't necessarily go up and down at the same pace or in connection with the stock market, because it's in a different sector. And I can kind of keep going out of here, or do you want to talk about some of these? Because I can
talk about I would love to talk about some of these because this is really we're talking about producing income from assets for the most part. This is kind of like the focus here, and so there are a lot of benefits to investing in these non-correlated assets, and that really being the key word is asset, a tangible physical asset, and especially in an inflationary period as we are in today. And inflationary, no, it is not transitory. We are in quite a pickle with the Fed, and we are going to experience inflation at least for the next few quarters, but long term, it's going to continue to play out just because of macroeconomic factors. Assets appreciate over time. And especially real estate. Actually, real estate is great during inflation because assets appreciate along with inflation. You can protect your income streams through diversifying. Let's say you have some in oil and gas, you have some in different kinds of real estate. You can protect those income streams. And a lot of times, these income streams are actually inflation adjusted, especially with rents and leases. You're seeing this right now with rents going, they're about 17% year over year growth in rents, which is very high. It's not normal, but your rents are going up. So your income streams are protected. And the more that we get into this phase where interest rates are going to increase as well. So there's all of these factors, not to get too much into it. I gave a presentation on macroeconomics before, but and I can give another one for wealth mastery later this year. But basically, what I'm trying to say is that right now you want to be in assets. They also give you depreciation, tax deferral benefits. And there's downside protection to assets because you actually own something as opposed to, let's just say, just stock market. Oftentimes it's called funny money, because unless you actually sell, you just have paper gains. And those paper gains can be eliminated quite quickly with volatility. And you mitigate risk by owning assets in so many ways, and you don't sacrifice returns when you diversify across different asset types. So even if you think about investing in private equity or you're investing in businesses, you can mitigate your risk by making some concentrated investments in certain businesses that are going to do well at certain points in time. Like during the pandemic, if you owned dollar stores, I wish I owned dollar stores during the pandemic. They did so well because they were necessities. It's a needs-based business, right? And you can think about things this way and find, even for yourself, like, oh, what makes sense to me, right? A lot of this isn't like, it's logic, it's observation. It's really understanding also what you want to invest in and finding businesses or real estate or opportunities that align with your values and with some of your goals. But the most important thing is that these asset investing, cash flow asset investing gives you a clear path to financial freedom that you can see today. And you're not putting your hopes and dreams into that retirement account.
Yeah. And that's what we were talking about, where it's easier than you think. The minute you just start thinking for yourself, you're able to make really good strategic diversification happen. So, the main point we just wanted today, because there's so much again to cover, and I know we've really talked about a lot. We just want everyone to really understand that real diversification goes far beyond having a 401k or an IRA that's full of stocks, bonds, ETFs, or index or mutual funds. That's not actually diversification. That's just still having all your eggs in one basket. Real diversification is active. You grow a garden of various investments and assets, different sectors, timelines, and structures, so that you're thinking strategically and you're honestly thinking a little bit for yourself. It's not actually rocket science. It's actually really not. It's actually very much like gardening. If you've ever gardened, the beauty of it is you buy something, you put it in soil, you make sure it gets a little sun, you add a little water. Maybe once in a while you take out weeds or add fertilizer, and voila, it grows. That goes to kind of what Aditya was saying. The nature of the universe, frankly, is expansive. And gardening is magically easy if you've ever done it. And actually growing money, when you can start thinking of it from this cultivation standpoint, and then you get access to really good information, you open your ears, you connect into a community of people that you can trust, and you gather information and you take ownership, it's actually a lot easier than we have even really maybe been taught to think or come up thinking. Ideally, if you do diversify actively, your ideal sort of financial garden should look maybe something like this. So what I love about this is like, it's such a perfect metaphor. You've got like the fencing, which is like for protection. You've got some stakes, those are all like the for me, it's like the risk management, the what if somebody attacks, the kind of worst case scenario. You've got a scarecrow to help, fight off any of the birds that might want to come. And then you've got a bunch of different growing things that are going to yield for you. And they're not all in one box. They're not all in one silo. They're tended, and there's a variety, and they're being taken care of. And this is maybe a really corny analogy, and maybe I've gone too far with it, but hopefully one way or another, you're kind of getting the point.
Yeah. So with strategic diversification, it requires creative thought, curiosity, and engagement. We're talking about strategic diversification includes capital appreciation. It includes cash flow, tax minimization, liquidity. There's different strategies. When we think about diversification strategically, we're thinking about different levels of returns, our goals on our timelines, asset classes or different types of investments, and also geography, like we said. So there are different ways to think about and diversify risk without diluting returns. So the key is to be strategic and always start with your goals and needs, plant a variety of seeds and tend them at least a little. Yes, ease and convenience. It's great. There's also a really great article that you can look up called The Tyranny of Convenience. It's a New York Times article. I highly recommend it because it gives you a really good look at what happens to us when we're trained not to think, when we're trained not to be proactive, when convenience basically becomes like an overlord. And we can't let that happen with our investments. We just can't. And it doesn't take that much time to be a little more active and to seek out investments and information. And that's what we're here for too, to have these conversations and to open the doors of our minds and to grow our portfolios. So it's easier than we think. And once you learn how to approach the garden the right way, and everyone's going to make mistakes because that's just the nature of everything and investing ups and downs, et cetera. Then doing that, even in a forum like this, even with a community of other women, and we're talking about it, that garden, like we're always going to be okay.